Forex Fundamentals and Trading. Chapter 15. Building a Forex Trading Framework. Section 1. Creating a Trading Plan. A trading plan is the document that tells you exactly how your strategy will be used in real market conditions. The strategy is the idea, such as trading breakouts or pullbacks, but the plan explains when you will look, what must be true before entry, how much you will risk, and when you will exit. That matters because markets move quickly, and unplanned decisions often become emotional decisions. A written plan creates structure before price starts moving, when your thinking is usually clearer. It also turns vague intentions into rules you can actually follow and review. In practice, the trading plan is what helps two similar chart patterns lead to one consistent response instead of two impulsive ones. A good trading plan should answer a small set of questions before you ever open a trade. First, what exactly will you trade? Which pairs, which setup types, and on which time frames? Second, when will you trade them? Because timing includes both the session and the conditions you want to see. Third, how will you manage risk and exits? So position size, stop-loss placement, and profit taking are already decided. And just as important, when will you stay out of the market? That last question protects you from low-quality trades around major news, poor liquidity, or moments when no valid setup is present. One of the easiest ways to improve consistency is to narrow your focus. If you jump between many currency pairs and several time frames, it becomes much harder to notice how one setup normally behaves. By choosing just one or two pairs and one or two time frames, you give yourself a smaller environment to study carefully, over a few weeks. That repeated exposure helps you recognize rhythm, volatility, and common false signals. It also makes journaling and review much cleaner because you are not mixing very different market conditions together. Many beginners think more choices create more opportunity, but very often more choices just create more noise. Entry rules should be clear enough that another trader could read them and identify the same setup you saw. That means replacing vague phrases like trend looks strong with measurable conditions such as price above a moving average, a bullish candle pattern at support, or an indicator reading within a specific range. You also want to define when you do your analysis, because a setup seen at the London Open may be very different from one seen late in New York. Objective rules reduce the chance that you talk yourself into trades that almost fit. They also make testing possible, because you cannot test a rule that changes meaning from day to day. A strong plan is specific not because markets are simple, but because discipline depends on clarity. Risk rules should be built before any trade is placed, not decided in the moment. Start by choosing the maximum amount you are willing to lose on one trade, often as a small percentage of the account. Then define where the stop loss belongs based on the setup, not on how much loss feels comfortable. Once risk and stop distance are known, you calculate position size from those numbers. After that, you can write down profit targets and any trade management rules, such as whether you trail the stop or take partial profits. It is also wise to limit how many trades can be open at once, because several correlated positions can quietly increase total risk. A complete trading plan does not stop at entry. It also explains how trades end, both when they go well and when conditions change. Your exit rules should state how profits are taken, whether at a fixed target, in partial stages, or with a trailing method. You should also define when a trade gets closed early, such as when the setup becomes invalid or a major risk event is approaching. Beyond exits, the plan needs a review schedule so you know when performance will be assessed. That review might happen weekly or after a set number of trades, and rule changes should wait until there is enough data to justify them. Written rules matter because most good trading decisions are made before the session becomes emotional. When the market is moving, it is much easier to chase, hesitate, or invent reasons to act. A written checklist gives you something neutral to compare against the chart. If the rules are met, you take the trade according to the plan. If they are not, you do nothing. That do nothing part is more important than it sounds, because patience is part of execution quality. Even a trade that makes money can still be a mistake if it broke your rules, because lucky rule breaking teaches the wrong lesson. Consider how a broad idea like trade breakouts becomes a specific decision process once it is written down. Suppose the plan says you trade USD/JPY on the 1-hour chart only when price breaks a key level and RSI is above 55. Your account is $5,000 and your maximum risk is 1%, so the most you can lose is $50. If the stop loss is 20 pips, position size must be calculated from that distance rather than guessed. The target is 40 pips, giving a 2-to-1 reward to risk structure, and the trade is skipped if major news is nearby. That kind of detail turns a general concept into something repeatable, testable, and much easier to review later. Many trading plans fail not because the trader has no idea, but because the rules are either too loose or too unstable. One common mistake is overcomplicating the plan with so many conditions that execution becomes slow and hesitant. Another is writing or adjusting rules after the trade, which turns hindsight into fake discipline. Ignoring position sizing is also dangerous, because a reasonable stop loss can still produce excessive account risk if the trade is too large. Costs matter too, especially on shorter time frames, so spreads and commissions should never be forgotten. And finally, changing the plan too quickly prevents you from learning whether the original rules were actually sound. A good way to make this practical is to build a simple plan from a fictional example. Imagine a $10,000 account and a focus on Euro/F on the 15-minute chart. Your task is to write 2 specific entry conditions that someone else could recognize, not broad opinions about what the market feels like. Then decide how much you will risk, where the stop goes, how position size is calculated, and where profits will be taken. Add one clear rule for when you will skip the trade entirely, such as a news event or missing confirmation. If you can write all of that in a short, clear format, you already have the foundation of a usable trading framework. Section 2. Journaling and Reviews. Once a plan exists, the next step is creating a record of how that plan is actually used. A trading journal matters because memory is unreliable, especially after stressful wins and losses. Without written records, it becomes easy to confuse luck with skill or to remember only the trades that felt important. A journal turns experience into evidence by preserving what happened, why it happened, and how you handled it. Over time, that record shows patterns you would almost never see from memory alone. It becomes one of the main tools for long-term improvement because it connects results back to decisions. For every trade, record both the hard facts and the thinking behind them. The factual side includes the currency pair, whether the trade was long or short, the entry and exit prices, position size, and the final profit or loss. Just as important is the context, what setup you saw, which signals were present, what the broader market environment looked like, and what session you were trading. You should also note your emotional state because feeling calm, rushed, or overconfident can change execution quality. Finish with a short lesson from the trade, even if the lesson is simply that you followed the plan correctly. A complete journal entry gives you data and meaning at the same time. Trade notes are most useful when they are written immediately after the trade closes. At that point, the reason for entry, the quality of execution, and the emotional state are still fresh and easier to describe honestly. If you wait several hours, hindsight starts changing the story, especially after a loss. You may forget details, soften mistakes, or invent a cleaner explanation than what really happened. That is why delayed journaling often becomes less accurate than traders realize. It is also important to log bad trades, not just good ones, because the losing trades usually reveal the most useful information. Clear journal notes describe the setup you actually traded, not the outcome you hoped for. Writing something like "looked bullish" is too vague to be useful later. A stronger note would name the strategy, list the key signals, mention support or resistance, and explain why the timing made sense. For example, you might write that this was a pullback to support during the London Open, confirmed by a bullish engulfing candle after major news had already passed. That kind of note makes review much more powerful because you can compare similar trades accurately. The goal is to capture the logic of the decision, not just the emotion of the moment. Your mental state deserves a place in the journal because trade quality is not shaped only by the chart. Before entry, it helps to rate your confidence and note whether you felt calm, rushed, distracted, tired, or stressed. Those conditions can affect patience, position management, and willingness to follow the plan. You should also record whether you completed your normal routine, because skipped routines often lead to lower quality decisions. Over time, these notes reveal whether certain emotional states are linked to stronger or weaker execution. That is valuable because many traders try to solve the behavioral problem by changing strategy rules when the real issue is mindset. Daily reviews are meant to be quick checks on execution, not full performance studies. At the end of the day, ask whether you followed the plan, whether the entry rules were fully met, and whether stop loss and exits were managed correctly. Also, look for small behavior errors such as impatience, fear, or trading a setup that was only almost valid. This kind of review can take just a few minutes, but it catches discipline problems before they become habits. It keeps the focus on process while the details are still recent. In other words, the daily review protects execution quality one session at a time. Weekly reviews do something different from daily reviews. Instead of checking one trade at a time, they look across a group of trades to find patterns. This is where you examine win rate, average wins and losses, performance by pair, and results by session or time of day. A weak week might reveal that one setup is fine overall but performs poorly in a certain session. A strong week might show that a modest win rate still works because your average winner is much larger than your average loser. Weekly reviews turn isolated journal entries into evidence you can use for smarter decisions. One of the most important review skills is separating execution problems from strategy problems. If a trade lost because he entered late, moved the stop, or ignored part of the setup, that is not evidence that the strategy failed. It is evidence that execution failed. A strategy problem looks different. The rules were followed correctly, but the setup itself keeps underperforming across enough trades. That distinction matters because the solution changes. Execution problems are fixed with discipline and routine, while strategy problems are fixed with testing, filtering, or rule adjustment. Imagine a trader named Carlos reviewing 20 journaled trades. He notices that the trades he felt most confident about actually performed worse than the ones he entered with more caution. His high confidence trades won only 2 out of 8, while the lower confidence group won 7 out of 12. The journal shows that many of those confident trades were entered too early, before full confirmation arrived. That is a powerful insight because confidence felt helpful, but the data showed it was leading him into premature entries. Instead of changing his whole strategy, he added a 15-minute recheck rule to slow down the decision process. A journal only helps if it becomes a consistent habit. That means recording every trade, whether it was a win, a loss, or a rule break you would rather forget. It also means avoiding vague notes and not waiting until the emotional charge has faded too much. Reviews should happen routinely, not only after a bad streak, because strong periods also contain lessons. Over time, this habit creates an honest feedback loop between what you planned, what you did, and what needs improvement. The goal is not perfect trading, but steadily better decisions supported by evidence. Section 3. Strategy testing. After journaling and review, the next part of a trading framework is testing the strategy itself. Strategy testing matters because an idea becomes useful only when it has been checked against evidence. A setup may sound logical, but until it is applied to market data, you do not know where it works, where it struggles, or whether it has any edge at all. Good testing is not about finding perfection or proving that losses will disappear. It is about understanding strengths, weaknesses, and realistic expectations. That process can also save real money by rejecting weak ideas before they ever reach a live account. Most Forex strategies are tested in 2 stages, and each stage answers a different question. Backtesting uses historical price data to ask whether the rules would have worked in the past. It is useful for exploring ideas quickly and seeing how a setup behaved across many examples. Forward testing comes afterward and asks whether you can actually execute the strategy in live market conditions. That includes handling timing, spreads, slippage, and your own behavior in real time. A strategy that looks good in backtesting but falls apart in forward testing is giving you valuable information, not simply bad news. A backtest is only helpful if the rules and assumptions are realistic. The entry, exit, and risk rules need to be precise enough that each trade can be judged consistently. Trading costs also have to be included, because spreads, commissions, and execution assumptions can meaningfully change results. It is important to test across different market environments rather than only in one favorable period. A trend-following strategy, for example, may look excellent during strong directional phases and much weaker during ranges, and every trade should be recorded, including clusters of losses, because losing streaks are part of what the strategy really is. Forward testing reveals what backtests cannot fully capture. In live conditions, spreads can widen, slippage can make entries and exits worse, and small delays can change the trade entirely. Even if the rules are sound, missed trades or hesitation can reduce performance. Emotions matter here too, because a trader may follow a rule perfectly on old charts, but break it when real money or real pressure is involved. This is why forward testing is not just a formality. It checks whether the strategy survives real-world friction and whether the trader can actually apply it as intended. A practical testing sequence keeps the whole process organized. First, define the rules clearly as a checklist, so there is no ambiguity about what counts as a valid trade. Second, choose a representative sample of market data that includes different conditions and enough trades to be meaningful. Third, run the backtest and log every trade carefully, including outcomes, notes, and any relevant context. Fourth, move to forward testing before risking real money, often in a demo account or with very small size. That sequence creates a path from idea to evidence to live readiness without skipping important steps. When testing a strategy, total profit is only one part of the picture. You also need to track win rate, average risk to reward, maximum drawdown, profit factor, and the number of trades in the sample. These measures work together to show whether performance is durable or misleading. For example, a high win rate can still be fragile if losses are much larger than wins. A low win rate can still be acceptable if winners are consistently bigger than losers. And small sample sizes can make any result look more certain than it really is. If forward results come in much weaker than backtest results, that gap should be investigated instead of ignored. Sometimes the problem is overfitting, where the rules matched old data too closely and did not generalize well. In other cases, the assumptions about spread, slippage, or trade execution were too optimistic. Vague rules can also create problems because they may have been interpreted one way in the backtest and another way in live conditions. The key is to revise only what is necessary and then retest. Constant tweaking after every setback usually creates confusion rather than improvement. Consider Sarah, who tests a breakout strategy and sees a noticeable difference between historical and lifestyle results. Her backtest shows 45 trades with a 58% win rate and a profit factor of 1.6. In forward testing, the win rate drops to 50% and the profit factor falls to 1.2. When she reviews the trade log, she notices that larger losses cluster around high-impact news releases. That discovery points to a specific weakness rather than a total strategy failure. After adding a news filter and retesting, the results become more stable, which is exactly what good testing is supposed to uncover. Several common testing mistakes can make a strategy look far better on paper than it will perform in practice. One is overfitting, where the rules are tuned too closely to past price action. Another is ignoring costs such as spreads, commissions, and slippage, which can quietly erase an apparent edge. Testing only favorable periods is also misleading, because markets do not stay in easy conditions forever. Changing rules during the test is another major problem, since it destroys the consistency of the sample. And focusing too heavily on win rate can hide a weak profit factor or poor risk profile. Section 4. Performance Analysis. Once a strategy is being traded and tested, performance analysis helps turn records into useful feedback. A journal tells you what happened on each trade, but analysis shows how profits were earned and whether those profits are likely to be repeatable. It also highlights the risks that may be hidden behind a decent return, such as unstable results or deep drawdowns. Short winning streaks can make a method look stronger than it really is, so analysis helps you see beneath the surface. In that sense, performance analysis is where raw trade history becomes decision support. It helps you move from observation to improvement. Profitability and consistency are related, but they are not the same thing. Profitability asks whether you are making money overall, while consistency asks whether that result comes from a repeatable process. A trader might show strong profit because of two unusually large winners, even though most trades are weak or unstable. Another trader might earn the same total return through steadier, less dramatic gains that are easier to trust and repeat. That is why smoother, more reliable performance is often more valuable than flashy but uneven returns. Looking at risk-adjusted return helps make that difference clearer. Several core metrics give structure to performance analysis. Win rate tells you what percentage of trades were profitable, but on its own, it says very little about overall quality. Risk-reward ratio compares the average win to the average loss, which helps explain whether a modest win rate can still produce profits. Profit factor measures gross profit divided by gross loss, giving a broad sense of whether the edge is positive. Sharpe ratio adds another layer by comparing return to volatility, so it speaks to how smooth or unstable those returns are. The key point is that no single metric should be used alone. Good analysis starts with clean trade data. That usually means exporting broker history or journal entries into a spreadsheet where trades can be sorted, filtered, and calculated consistently. At a minimum, include entry and exit dates, pair, direction, prices, position size, and profit or loss. If possible, add extra fields such as session, setup type, and overall market conditions. Those extra tags become extremely useful later when you want to compare performance by time of day, strategy variation, or environment. Clean inputs make useful analysis possible. Messy records make reliable conclusions much harder. With clean data, you can calculate the main statistics that describe your edge. Win rate is simply winning trades divided by total trades. Average win and average loss show the typical size of your gains and losses, which matters just as much as how often you win. From there, risk-reward is calculated by dividing average win by average loss, and profit factor is gross profit divided by gross loss. These numbers often reveal why surface impressions can be misleading. A trader with a high win rate can still lose money if losses are too large, while another trader can profit with fewer wins because the winners are much bigger. Sharpe ratio is useful because it adds a risk-adjusted view of performance, but it should be handled carefully. The basic idea is to start with average daily return, subtract the risk-free rate, often simplified to 0, and divide by the standard deviation of daily returns. That tells you how much return you are earning relative to the variability of those returns. The result can then be annualized using the square root of 252 trading days. In plain terms, a higher Sharpe suggests smoother return for the amount of volatility taken. But small samples can exaggerate confidence, so Sharpe works best when it is supported by enough data and other metrics. Overall results often hide the insights that matter most, so it helps to segment your data into smaller groups. You might compare performance by session, by currency pair, by long versus short trades, or by day of the week. A strategy that looks average in total may turn out to be strong in London and weak in Asia. Or one pair may consistently perform better than another even when the same setup is used. These patterns often suggest small execution changes rather than a total redesign. Segmenting results helps you refine where and how the strategy is applied. Drawdowns and weak periods are uncomfortable, but they are often the most educational parts of the record. When performance dips, look closely at whether losses clustered around major news, whether trades were taken outside the plan, or whether stop-loss rules were widened or ignored. You should also watch for overtrading after a loss, because emotional recovery trading can deepen a drawdown very quickly. The point is not to treat every losing stretch as proof of failure. The point is to investigate whether a specific rule, condition, or behavior is repeatedly involved. Weak periods often show exactly where discipline and risk control need reinforcement. Take Maria as an example. She trades Euros Aussie USD with roughly a 1 to 2 risk-reward structure and records 100 trades, with 48 winners and 52 losers. At first glance, a 48% win rate may not look impressive, but the larger average winner gives her a profit factor of about 1.86, which is quite solid. The segmented analysis adds even more value because it shows that her best session is London, while the Asian session is much weaker. That suggests the strategy itself may be fine, but its application is uneven across sessions. A smart adjustment would be to reduce or stop trading during the weakest period, rather than changing the whole method. Performance analysis only matters if it leads to specific, measurable improvements. The goal is to use data to set clear targets, such as improving profit factor, reducing oversized losses, or avoiding low-performing sessions. Those changes should be based on enough trades to be meaningful, not on a few recent outcomes. It is also important not to overfit the past by forcing the strategy to match old data too closely. Good analysis creates focused decisions and then checks whether those decisions actually help. In that way, analysis becomes part of an ongoing improvement cycle rather than just a report card. Section 5. Continuous improvement. A strong trading framework is never completely finished, but that does not mean it should be constantly rebuilt. Improvement works best as an ongoing cycle of review, learning, and careful adjustment. Markets change over time through shifts in volatility, liquidity, and broader conditions, so a trader needs a process for staying responsive. The key is refinement, not endless redesign. Review connects data to action by showing what is still working and what needs attention. Progress usually comes from steady updates to a stable framework, not from repeatedly throwing the whole plan away. Your records are the main source of feedback for continuous improvement. Weekly journal reviews can reveal whether rule violations, emotional decisions, or certain market conditions keep appearing around poor trades. Often the problem is not the entire strategy, but one recurring behavior or one condition where performance weakens. For example, you may discover that results are fine overall except during news-heavy sessions or after rushed entries. That kind of pattern is actionable because it points to a narrow area for improvement. Good records help you diagnose the real issue instead of guessing. Continuous improvement becomes much more effective when it focuses on persistent weaknesses rather than every uncomfortable result. One trader may notice that a specific currency pair underperforms, another may find that entries are poor at a certain time of day, and another may see repeated rule violations after losses. These are the kinds of recurring issues worth isolating and studying. If you try to fix everything at once, you lose the ability to tell what actually matters. A stable framework with one clearly identified weak point is much easier to improve than a framework being rewritten from every direction. The goal is to study the pattern, not react to the emotion of a single bad trade. One challenge in trading is telling the difference between a real pattern and normal randomness. A few losses in a row do not automatically mean something is broken, especially in systems with modest win rates. Short streaks can occur even when the strategy is healthy. That is why traders should avoid reacting too quickly to recent results. A larger sample, often around 25 to 30 trades, gives a better basis for judging whether a change is meaningful. Patience here is part of discipline, because overreacting to noise can damage a sound process. Once a recurring issue is identified, the best response is to make one testable adjustment. Choose a single variable, such as a session filter, an entry confirmation, or a stop-loss rule, and write the new rule clearly. Keep the rest of the framework unchanged so the effect of the adjustment can actually be measured. It also helps to define success in advance, such as better win rate, lower drawdown, or fewer oversized losses. If many variables are changed at once, the result becomes impossible to interpret. Controlled improvement depends on being able to say what changed and what happened afterward. After the rule change is written, run a controlled trial. Apply the new version over a limited sample, often around 20 to 30 trades, and record those trades separately from your normal baseline. Then compare the two groups using the same measures, such as win rate, average win, average loss, or risk-adjusted return. The aim is not to find instant perfection, but to see whether the adjustment produces a meaningful improvement. If the difference is small or unclear, the rule may need more testing or may not be worth keeping. This trial process keeps changes evidence-based instead of emotional. Imagine Alex trading Euro USD with a trend-following approach. Over 100 trades, his win rate is 55%, which suggests the method may still have an edge. But his journal shows that many losses cluster early in the New York session and especially around major data releases. That points to a timing problem rather than a complete strategy failure. Instead of restarting with a new system, he adds one rule: no new entries around high-impact news. Then he tests that adjustment over the next 25 trades to see whether stability improves. The result of Alex's trial is stronger, which supports keeping the new rule. His trial win rate rises to 65%, and average loss falls by about 15%. Just as important, the broader framework stays mostly unchanged, so the improvement can be linked to a specific adjustment rather than guesswork. This example shows the value of a disciplined process. Identify the issue, isolate one variable, test it, and evaluate the result. The lesson is not that every change will work this well. The lesson is that data should guide the decision to keep, reject, or refine a rule. Improvement does not have to come only from your own records. Outside input, such as education, mentors, or community feedback, can help reveal blind spots and strengthen your understanding of market structure or risk. The important part is being selective. New ideas should support your framework, not pile on top of it until the process becomes confused. If outside advice fits your style, rules, and evidence, it can be tested carefully like any other adjustment. The goal is to improve your process, not to chase every attractive idea that appears. The biggest mistakes in continuous improvement usually come from reacting too quickly or changing too much. If you adjust several variables at once, you can no longer tell what caused the result. If you mistake normal noise for a meaningful pattern, you may damage a strategy that was still sound. Some traders abandon a workable method too early simply because they have not gathered enough data. Others fail to document changes, which makes learning almost impossible. Disciplined improvement means testing one change at a time, keeping records, and letting evidence shape the next step.